Ireland could come back to the market with a 10-year. This is crucial, right?
Well, yeah, I think you're going to get a good idea of what investors are looking at right now. There's been general strength across the periphery bonds. Italian bonds, Spanish bonds have also been rallying, and Italy's also going to be coming to the market today. So I would expect some strength. I'd expect good attraction for these bonds, but our view is that these bond yields will be moving higher at some point. There will be an issue within Europe, within Italy. There will be something that pushes these yields higher. So I think if you're buying them and holding them forever, you're going to be okay, but I think there's going to be a better entry point.
Would you be a buyer of Italy over Ireland or Ireland over Italy?
Right now we've got a position on where we're looking at more buying short-term Spanish debt and shorting Italian longer-term debt, and it's a carry-neutral strategy, but it really works well if spreads do widen because you're much longer duration on your short position. So it's a hedge against risk aversion as well, and it's a zero-cost hedge.
How, looking at the Italian context, how long before the markets, which have, let's face it, been pretty sanguine about what's been going on there, how long before they start panicking about what's going on in Italy?
Well, every year for the last 3 years, every springtime, there seems to be a bit of a risk aversion, a correction in equity markets. Some worry about the Eurozone, some country within it. And I don't know if that'll play out this year, but it wouldn't surprise me. You can't see a real catalyst for the trigger. The ECB seems to be behind the periphery bonds, but the OMT is not being activated, and it's probably there. It's there as the backstop. But I think the market will force hands and really push the ECB to get in there in the OMT activation, probably for Spain first. And that's the time to be buying the bonds rather than buying it right now when everyone is a bit comfortable.
Just very quickly to finish out, what is your take on the whole rotation right now, where we are in that? How vulnerable that shift is?
You're seeing equities rally, you're seeing inflows into equities, but you're not seeing much capital outflows out of bonds really yet. So I don't even know if it's fair to call it a rotation. The market's calling it a rotation, press is calling it a rotation, but you're seeing flows into equities. I think you should see flows out of bonds with negative real yields. We are short some of the lowest yielding bonds. The French bond, I think, is something no one should be owning right now. I think it still has legs, but I think there will be moments of risk aversion that you'll see the risk assets probably sell off this spring at some point.